Hello and welcome to CNBC-TV18. You're with us on a special show. We're calling it Market Sell-Off. I'm Prashant Nair. With me, my colleague Ekta Batra. Ekta, hi.
Hi, Prashant. Well, yes, definitely a tough start to the week. Let's take you through all of the top stories that we're tracking at this hour, and then let's get in some opinion. Weak global cues fueled by global recession fears ensure Indian stocks widening their negative run rate for the year. Sensex and Nifty lose over 1% each. Mid-cap index falls over 3%.
The rupee weakens to an all-time low of 81 rupees and 65 paise to the dollar as fears of a global recession send the dollar surging to multi-year highs against most of its rivals. All eyes will be on RBI's rate decision later this Friday.
Dollar strength rattles most major currencies. The British pound slumps to a record low after new UK government announces tax cuts. Currencies across China, Japan, South Korea also weaken against the dollar.
Global crude oil prices continue to fall for the second day in a row on worries that demand from major consumer nations may take a hit. The dollar's global surge also limits buy orders from non-dollar consumers.
Britannia ropes in Rajneet Kohli, who led Jubilant Foodworks India business as ED and CEO, elevates Varun Berry to Vice Chairman and Managing Director. The street gives the move a thumbs up. Well, those were all of the top stories that we are tracking this evening. Well, it's been a definitely tough day with the mid-cap index ending at the lowest point of the day, down over 3% We have the Nifty, which just about held on to 17,000. Well, Prashant, it's obviously the global recession fears. The US has, rattled sentiment across the board. Tell us more. Today was tough.
I mean, finally things caught up, right? I mean, I think that's all there is to it. Not very much. I don't think there is anything new which has happened when we closed last Friday and when we came back this morning, except the fact that on Friday itself, there were the first cracks which started to appear in, what I've been calling the Teflon coating that the market here has had. Nothing very much has affected the market here. The outperformance has been very, very stark. So I'll just repeat what's been going on. It's the global repricing of the risk-free rate, right? Which is basically the US 2-year, the US 10-year. That's the risk-free rate. That's been moving higher because the US Central Bank wants to control inflation. They've told the markets repeatedly for some time. The market continued to disbelieve it, saying, well, looking for a pivot. And now I think, expectations are getting entrenched that they will walk the talk. So that is basically what is the underlying reason for all that is happening. As a consequence of this, financial conditions are tightening. The most prominent signal for that is the US dollar. When the dollar goes up, that's a signal of financial conditions tightening. It's negative for emerging markets because that's the channel through which bulk of the foreign money comes into emerging markets like India. All of this also means that a global recession perhaps is likely. Big pockets of growth. You take the US, for example, which of course is the stronger of the lot. Europe, which of course is the weakest, and now China are all under severe, immense pressure. Growth is faltering quite rapidly. We'll come to what's happening in UK, for example, as a case in point, but that's just one of the many examples. Dollar, as a consequence of all of this, money goes home. There's uncertainty, money goes back home, and home is the US dollar. The dollar has been rising. What that is doing is it's putting pressure on a whole host of currencies, not just emerging markets, but even developed market currencies, the euro, the pound. But it's not just the dollar rise. Each of these countries, as I just described, or each of these blocks of countries are having their own issues as well. And on top of that, you got the dollar, which is it's like a negative feedback loop, and that is continuing. Here in India, for the last 3 or 4 months, the Reserve Bank of India has doggedly defended the 82 dollar mark, the USD INR. But that went, once the 80 level got taken out, the understanding, what we understand, etc., and Lata will talk about this in a bit more detail, is that the RBI is standing away. They're no longer kind of selling dollars, supplying dollars to the market. They want the rupee maybe to find, or rather catch up with other currencies and what the dollar wants to do. So not waste good dollars after defending what may not be possible to defend at this point in time. Let it fall a little bit. The RBI, as a result of that, will have to intervene in other fashion, which is basically increasing rates. It may not want to do a 50, but I think market expectations are now quite clear that a 50 basis point rate hike perhaps is coming. That is later this week. Just a quick word on the markets. The Nifty fell, as Ekta also pointed out, by 300 points. That's about 1.75%. Metals, autos, real estate in stock sort of sectors were the worst performers. The IT index was the sole gainer, large block of stocks which actually gained nothing large. I mean, small green there, and 1:10 in terms of advances to declines ratio. So for every one advancing stock, there were 10 which were lower. That kind of told you the story. I would say that maybe there is a bit more in terms of catch-up lower, which is pending because the outperformance, the extent of the outperformance on most time frames has been pretty staggering, so as to speak, Ekta.
Yes, absolutely, Prashant. And the extent of outperformance, not for the equities or rather resilience, but it's also prevalent in what we've seen in terms of the rupee, in terms of comparative depreciation. But to talk more about this, we have Mihir Vora, Director and Chief Investment Officer at Max Life Insurance, joining on the show this evening. Mihir, hi, welcome to the show. How exactly would you approach this weakness at this point?
Good afternoon, Ekta. I think we are just, in a situation where the global headwinds are far stronger than the domestic buoyancy that we are seeing in the economy. So I think what we can do is just wait and watch and, just try to tweak around the portfolios depending on how fast the stock price movements are. But there's not much you can do when there is so much disruption in all asset classes. The bond markets are disrupted, the currency markets are disrupted, the real estate markets, especially in the Anglo-Saxon countries, US, Australia, New Zealand, we are seeing sharp correction in the real estate markets there. So stocks also cannot be unscathed, and there's not much you can do at this point in time except to wait and watch.
Will the aggregate market, Mihir, settle a lot lower, you think?
I don't know. It depends, because so far we've been very, pleasantly surprised by the amount of money coming in from the domestic institutions, whether it's insurance companies or mutual funds or even the PMS schemes and the AIF schemes. We also have this big chunk of money coming in from the National Pension Scheme system. So there is a lot of domestic liquidity which can buy stocks, but whether that will be overwhelmed by FII selling is something that we need to monitor.
Okay. Well, Mihir, one of the big sectors of the day, and we will talk about it more in detail in just a bit, has definitely been IT, which showed some amount of resilience today. But obviously, the likes of Wipro is down over 40% on a year-to-date basis. Do you think that there could be some buying at lower levels which could emerge for IT stocks, and how would you approach them?
See, maybe a tactical trade because people are observing the rupee movement against the dollar and trying to, punt around. But I think structurally the best of what we saw over the last 2 years for IT demand is over. It will not be as strong as we've seen in the last 2 years. And one also must not forget that, yes, while dollar revenues are maybe 60, 70, 75% for a lot of companies, there are pound revenues and there are euro revenues and there are Japanese yen revenues. And all those currencies are getting hit badly against the US dollar. So to that extent, the cross-currency impact is also to be considered. So I would not, just because of the rupee depreciating against the dollar, I would not go and buy IT just on that reason alone.
Mihir, domestic-facing sectors with little to do with outside, although even domestic-facing sectors have global linkages. I mean, all sectors now is a linked world, but lesser to that degree. Banking and financial services, consumer sectors, are those places to look for opportunities as the market, corrects, is the prognosis?
Yes, so it's banking and financial services, consumption link, whether it's discretionary or non-discretionary, and the infra and capex link themes. So those should continue to do well structurally over the medium term. Within the banking and financial services, because we expect liquidity to continue to tighten at least for a while, I would prefer the banks versus the non-banking financial services companies, because you do see there is a tightening of financial conditions. So to that extent, a lot of NBFCs tend to be wholesale borrowers, and wholesale borrowing rates are going to get tighter and tighter. In that situation, the banks with a good CASA franchise, good deposit franchise, can find that the liability part gets repriced slower, and the asset part, which is the lending part, gets repriced higher. So the pricing power actually tends to benefit. So within the banking and the financial services space, I would stick to the banks and not the NBFCs. And even the pro-capital market link segments would probably be something that I would wait before entering.
Okay, just talking about this whole domestic demand theme and the fact that we're entering more into a higher interest rate environment, how would you approach the entire auto space? Because M&M, Eicher, Maruti, all of these stocks have given returns on a year-to-date basis, Mihir. But now, do you think that things could get a bit tentative?
We've seen that auto demand really is not a function of interest rates. It tends to be a function of how well the urban and rural economy is doing. So to the extent that we have buoyancy in the job markets and rural economy doing well because of the busy season coming up, those are the factors I would kind of look at. Interest rates, I don't think we are that sensitive yet.
Okay, we're not that sensitive yet. Any other pockets within domestic consumption where you look for opportunities which you'd want our audiences to pay special attention to? I mean, you get bargains when markets come off, right? Aggregate markets come off, and you don't want too much damage, but that's when you find opportunities as well. So, any particular pockets, Mir?
So some of the commodity using FMCG and discretionary segments have suffered in the past few months as commodities have been very tight, especially after the Ukraine crisis happened. We saw food grains prices shoot up. We saw chemicals prices and oil prices shoot up. So the users like FMCG companies which use food, milk, even packaging material is based on oil, etc., and some of the paint companies, etc., which have been users of commodities, they did see some sentiment negative, and they were marked down a bit in the last 6 months. So maybe some of the user segments can come out, and we've also seen that FMCG tends to be a bit of a hiding place in volatile times. So you might see some shift of money as a hedge in these volatile times to FMCG and other discretionary sectors which use commodities in a big way.
All right, Mir, quick chat today. Thank you so much for taking other time and being with us here on the program. Always helpful. Thank you. Well, the big story, apart from what's happened to stock market, was the rupee plunging to an all-time low. It's gotten past the 81.5 mark now very, very quickly, as we were discussing earlier. My colleague Lata is here to kind of sort of tie in, because there are so many moving parts to this story, the rupee and the currency story. Lata, over to you.
Clearly, the pound going to a fresh 37-year low and those unexpected tax cuts was the fresh negative over the weekend. Dollar going to 114 and US yields at 3.79 on the 10-year and 4.2 on the 2-year. These large global funds, for them, it immediately means taking off money from EM currencies because the risk-free return is coming in at 4.2 in the 2-year. There's no currency risk over there. And here, the interest rates are not matching, more because of the losses on the currencies. And of course, all Asian currencies saw that impact, and the NDF market already moved over the weekend. So early morning, we were merely correcting to all this. Dealers tell us that it isn't as if FIIs have come in and bought dollars because they have sold off shares, nor is it that importers are coming and panicking and buying because they may not get at 81, they have to pay 82. Nothing like that. It's not real economy moves. It's clearly these large funds which move across countries which have been responsible for the recent fall. They'll really watch RBI, and RBI will be watching the funds, actually. If there is exit from the market, then the Reserve Bank perhaps will let go a little bit more. Because beyond a point, when the reserves start going 550, 525, billion dollars, there is also a psychological impact. Depreciation begets depreciation. The market is now only watching RBI to find out where RBI puts the next big stop. And then perhaps exporters will come and sell. They usually do sell, actually, in the last week of the month. So now everyone's believing that there perhaps will be a catching of the breath between 81.5 and 82. But of course, global factors can have a different design. The bond markets also bear watching. Like I told you, the big movement is actually the yield movement. This 3.79 on the 10-year in the US and 4.2 on its 2-year has led to Indian bond yields being yanked up despite the fact that crude is actually to our advantage. Now, the OIS market, overnight index swap market, it's a very swift market. That one is already priced to 50 basis hike, and a 50 basis hike on a Friday, that is. And if you look at the 1-year OIS, it is pricing in something like 6.9, 6.95, which means, you know, a repo of a peak rate of even 6.75, in keeping with the higher Fed rate, is getting priced in by the market. All these are, of course, position taking. We have to wait and see. But from a stock market angle, what you need to know is now the 10-year yield, as we approach September 30, is higher than what it was on June 30th. So banks, while they were benefiting from the upper interest rate cycle, are now sitting on mark-to-market losses. That is the big thing every bond desk tells us. Oh, we are sitting on losses when it comes to the quarter. So that's something of interest to the markets.
Okay, all right, Lata. Thanks very much for that. So over 9% appreciation in this year for the rupee. Time for a break now, but stay tuned. We'll be back with all of the other top stories.